Most traders and investors get crushed when the market suddenly crashes, but there's a simple option strategy that can make big returns in these conditions. And in this video, you'll learn how to implement it correctly in step-by-step detail. I'm Seth Freudberg, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You found the right place to learn. Just when you thought the market was just going to rally forever, riding the artificial intelligence euphoria into the sunset, the market will make sure that you're reminded that every day that the market rallies is one day closer to a pullback or even a crash. But of course, it's also important to remember that the deeper the market pulls back or crashes, the closer you are to that sell-off reversing as well, often into a screaming rally. And that's the way the market's always been, and it always will be. And so the purpose of this video is to share with you the way that options traders look at crash scenarios like we experienced earlier this week when the S&P 500 gapped down over 4.2%. Crashes create challenges for certain kinds of option strategies, but what a lot of traders may not realize is that they also create fantastic opportunities if you understand the right strategies to use to leverage those situations. Before we get into the option strategy that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategies that we'll be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of the video. Monday morning on August 5th, while the SPX index was gapping down almost 225 points, something else happened that morning that you may or may not have noticed, and that is that the VIX index skyrocketed to 65, an enormously high number for the VIX, which has a normal range of 13 to 19. So that morning, it reached about 4 times its normal range. And so what that means is that there was huge fear in the market on Monday morning, which translated into huge prices for put options on the indexes, such as the SPX index. And so we decided to look back over the last 10 years to see just how often this happens, that the VIX climbs over 50. And you might be surprised to know that it's actually a very unusual occurrence and has only happened 4 different times in the last 10 years, as you can see. It happened back in 2015, 2018, right at the start of the COVID crash in 2020, and this week, the first Monday in August of 2024. And so you'll notice from this chart that after a spike like this, there has historically always been a pullback in the VIX, which basically means that whatever was causing the fear eventually subsides, a phenomenon that options traders have noticed for decades, the tendency of the VIX or options volatility to return to the mean. In other words, fear doesn't stay super high for long. It usually subsides down to more normal levels as the market bounces from that peak fear moment. And so what that means is that there's a pattern there that can be used to a trader's benefit by trading SPY options, because the SPY, of course, is the popular ETF that represents stocks that comprise the S&P 500 index, which is therefore a pretty comprehensive way of trading the entire market, if you think about it. So let's head back to the first of these instances back in August of 2015, when there was a Chinese currency devaluation crisis that was started on a Sunday evening. And by Monday morning, the VIX had spiked to over 50. And the SPY dropped to close to 7%, opening at 183.87. And so if on that morning at the open, if we had opened up an options chain expiring as close as we could find to 6 months out, which in this case was the March 18th options chain, and we went ahead and looked at that column called Delta on the SPY options chain, and we proceeded to sell 100 of the SPY put options with a delta of around 40, which in this case were the 180 puts expiring in March with a delta of 43.28. And we simultaneously bought 100 of the puts 5 points lower at 175. So when we do this, we are entering into what options traders refer to as a put credit spread, which is a bullish trade, as you'll understand shortly. Now, what's known as an options delta is a mathematically arrived at prediction of how much an options price is likely to move based on how much the stock price moves that option is based on. In this case, the SPY stock. And every options broker will have a column available to you called delta on your broker platform, and it can be found easily for both puts and calls on any options trading platform. Let's now make sure we understand the initial cash flow of this trade, as that's critical to how and why this is such a high probability trade. And as you can see, we sold those 180 puts for $13.66. And remember, each equity option pertains to 100 shares of stock. So you multiply that by 100, and you sold 100 of them. So you multiply it again by 100, resulting in a total cash inflow from selling those 100 puts of 136,600. But then you simultaneously bought 100 of the 175 puts for 1157. So using that same kind of calculation, you see that those cost you $115,700, which results in net positive cash flow in the amount of $20,900, which goes right into your account and will increase the cash balance of your account. Now, your broker is going to require you to have at least $29,100 to put this trade on in the first place in capital, which is also the trade's worst case scenario. So if that's too much risk for you, then you just want to scale back the lot size. Now let's move to the day this spread expires, which is March 18th, 2016, a little over 6 months later. And as you can see, the SPYs had rallied to 204.37 after that initial crash day back in August. And so now that it's expiration day, we can actually calculate whether this trade was successful or not. And that's going to be very straightforward in this case, because with the SPY closing at 204.38, let's see what happens to the value of the individual options. And starting with the cash we initially received for selling the put credit spread in the first place, that $20,900, taking a look at the 180 puts, we can see that they expired worthless because those puts expired over 24 points lower than the SPY's closing price. And obviously, a put's worth nothing if it gives you the right to sell your shares far below what you could fetch for them just in the open market. And of course, the same goes for the long puts below that at 175, even farther out of the money. And so both puts expire worthless, and you simply pocket that initial cash you received, which in this case resulted in a 71.8% return on the capital risk. And that's in a little bit over 6 months. Now let's move to the next time that this took place, which was 3 years later, when there was a sell-off in the market in early 2018. And as you can see, after rallying for many consecutive months in early February of that year, SPY rolled over and began to sell off aggressively. So aggressively, in fact, that the VIX again spiked above 50, as we mentioned earlier on this date. And so we again go out to the closest expiration that will get us up about a 6-month trade, which in this case is the July 20th expiration. And we sell the puts around 40 delta again, which in this case are the 260 puts, and we buy the 255 puts in the same quantity. And in this case, as you can see from the calculation, we collect $15,100, this time requiring $34,900 in capital. Now, moving forward to the day that this trade expires, we can see that the SPY again rallied after bottoming out in early February, closing at 279.68, and therefore, once again, both the 260 and 255 puts expired with no value, leaving us with all of that cash again, the $15,100 that we first received upon trade entries, resulting in this case in a 43.2% trade return. And finally, moving to the most recent example, prior to this past Monday, of course, and that is the COVID crash of 2020, which started in late February, really, but it wasn't until March 6th, as you saw on the earlier chart, that the VIX exceeded 50. And so we pull up this time the September 2020 options chain about 6 months later, and with SPY gapping down another 3% to 293.38, we again look for the 40 delta put option, which in this case is the 285, selling 100 of those and buying 100 of the 280s, which results in our collecting $17,200 against $32,800 of risk this time. And moving forward to the day the trade expires on September 18th, as you can see, again, the SPYs rallied off of their pandemic lows, closing at 330.65, in large part because of the very strong fiscal and monetary stimulus injected into the economy during the pandemic. And so again, this resulted in both of the options expiring very far below the SPYs price, resulting in yet another high return win. Now, you might be wondering why this phenomenon has been so consistent, and that's attributed to a couple things. First of all, very often when the VIX spikes that high, it's often a sign that the selling is beginning to be frantic and emotional, and that in turn is often a sign that we're getting kind of close to the end of that sell-off. And that's logical, right? Because when a large majority of the market is just dumping shares at pretty much any price they can get, there are going to start being a lot of stocks selling for compelling prices that investors start noticing and ultimately start scooping up at bargain prices. And this in turn leads to upward momentum. And secondly, and very importantly, there's something very specific to options trading at play here, and that is that when the VIX spikes like that, so high, it means that options, particularly put options, have gotten much, much more pricey than usual. And so if you sell put options closer to the stock's price, those are going to be more expensive than the ones you're buying to protect your position, the long options, and that's why you receive a credit for this transaction. And that's true actually at any time. But the fact is that that credit is going to be much larger than normal because the VIX is so high and those options prices are so inflated, and therefore the return on those trades is going to be much higher than normal, and you become the beneficiary of that. And so that normalization of options pricing, which happens when the VIX spike subsides, like we talked about earlier, combined, of course, with the rally, which often ensues shortly after that VIX spike, as well as just the flat-out passage of time, all of those factors combine to give you the kinds of super high returns that we've mentioned in these three examples. And so what I'd like you to take away from today's video is that you should be aware of the fact that when you get these big VIX spikes, and they don't happen very often, so you got to be patient, but when they happen, it can be an exceedingly rewarding event, which are the kinds of trades that prop traders are looking for all the time.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.